Thank you for joining us today on our Zoominar on RCAs and IPPs with Ashley Searle, Head of Financial Planning for Canaccord Genuity Alberta, and Ryan Ackers, VP of GBL Inc. My name is Jeff Hunter. I'm a Portfolio Manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line as well is our lead investment advisors, Dave Townshend and Raheem Somani of Canaccord Genuity. For more information about our team, please check out mywealthmanager.ca. Just stop sharing this. So a couple housekeeping items before we get going. This call is being recorded, so we are keeping the lines muted just for ease of flow. If you have any questions, there's a chat bar below. Please type it in, and we'd be happy to ask Ryan or Ashley and help you out further from there. And with that, I'll leave it off to Ashley and start it off.
Hello, I am Ashley Searle. I am with Wealth and Estate Planning Services in Calgary, Alberta, working with Raheem and Dave and Jeff. And I would like to thank our guest very much for joining us today. Ryan Ackers leads a national actuarial consulting firm, Gordon B. Lang, or GBL. Founded in 1995, GBL is a national and leading provider of retirement solutions for business owners across Canada. With offices in Calgary and Toronto, GBL is Canada's largest provider of individual pension plans, or IPPs, and retirement compensation agreements, or RCAs. Ryan is one of Western Canada's most trusted IPP and RCA experts. He's a graduate of the University of Toronto, and he is currently in the process of continuing and completing his MBA through the Ivey School of Business. Ryan works with advisors, accountants, tax lawyers, and small to medium business and professional corporation owners to implement GBL tax-saving retirement solutions. Thank you very much for joining us today, Ryan, and I'd like to pass it over to you now.
Well, thanks, Ashley. It's always a pleasure to work with you and Jeff and your office in Calgary and across the country. Canaccord's been a great partner with GBL. So thanks for joining, everybody. I'm just going to share my screen right now and go full screen here. So as mentioned, my name is Ryan Ackers. I'm a Vice President of GBL, formerly Gordon B. Lang & Associates. So we're the market leader in individual pension plans and retirement compensation arrangements in Canada. To put that into perspective, we got about 22–23% of the total market across the country. And both of these products have been very popular since about 2016, and especially after the new passive income rules came through, and now that we're forecasting what taxes are going to look like in the future to pay for the economic recovery plan for COVID. So let's jump into it. So I'm just going to ask, and just kind of think about this. You don't have to raise your hands. Usually I do this in person. Who's here because they believe that business tax rates have changed positively since 2016? So we've got a bit of a COVID-19 special edition here. So given the debt that Canada has grown in order to combat the disease, who believes that post-COVID-19 tax rates will be favorable for business and professional corporation owners? Particularly those who are fortunate enough to be earning profits throughout the crisis, even if those profits are less than what was earned in 2020. So here are some recent headlines about what some of the writers think is going to happen with tax rates going forward here in Canada. Not a great picture, especially for business and prof corp owners. Now, here's a photo. So Ashley mentioned that I just completed the MBA at Ivey Business School. Now here's a photo of the first annual Silly Shorts Day. And you're probably asking, well, what does an actuarial firm know about future tax rates? I will add that myself and a few of my classmates correctly predicted what I'm sure everybody is wearing right now. So it's always business on the top and party on the bottom with COVID because obviously we're doing things over camera. So I always promise that when we do this presentation, there's one pun and one joke. That's the joke there. So keep an eye out for the pun. So let's jump into it. So we've got a retirement reality that's not so new anymore. So it's not really a secret that 50% of Canadians don't have adequate retirement savings. 1 in 10 private sector workers currently have a defined benefit plan, and about a quarter of the population falls into the baby boomer category. Defined benefit plans are setting up a confrontation between the lucky haves versus everybody else. That's our finance minister on record saying that. Yet out of the 3 million public sector workers in Canada, 80%, or 8 in 10, currently have a defined benefit plan. Well, that's odd. What's going on with this number here, this 1 in 10 number? Right? So obviously there's a disconnect between what the finance minister perceives and the reality for a lot of businesses. And I promise that's as political as we'll get today, but it's just been fact over the past 4 years. Let's address some myths before we go any further here. So the first myth that we often hear is registered plans, be it an RRSP or an IPP, don't work for individuals whose marginal tax rate will be the same at retirement as it is today. Registered plans are inefficient because they don't benefit from lower capital gains taxes or dividend tax credits. And you pay more taxes with registered plans at retirement. So we had our actuaries crunch the numbers, and they determined that with a registered plan, you're better off if your marginal tax rate at retirement is the same as it is today. If it's lower than it is today, that's in part how the system works. And if your marginal tax rate at retirement is even higher than it is today by a difference of 9% or less. And we can't make claims of that like that without jumping into some numbers. So if everybody can follow my cursor here. So we've got an individual who's in the highest tax bracket, who's got $200,000 of their money that they need to decide to put into a registered or a non-registered account. Now in this scenario, we're doing a bit of a stress test. So we're assuming that tax rates at the highest margin are going to increase 6% in retirement. So, you know, hopefully this is just a stress test and not a reality. We'll see what happens after COVID-19, but I doubt this will be the case. But we want to show you the worst case scenario anyway. So that individual takes $200,000 of their money, and let's start with a non-registered path here. So they put it into a non-registered account. 48% tax has been paid on that, so they're left with $104K. We're assuming they're 40 years old and they're going to retire at 65. And we're assuming a 5% annualized return, which we think is reasonable these days. That's where our assumptions here come from. At the end of this period, those assets grow quite a bit. Right? We're up to 352K, so over 3 times as much. There is still going to be some tax paid on the growth when they take it out. Right? So they're left with 285K. If we go back to the registered path, that 200K bypasses that 48% tax. We got the same assumptions here. Those assets grew quite a bit more in the registered plan. Now, this is where the painful part happens with registered plans. There will be more tax paid at this point. But as you can see, the client is still better off with the registered plan than the non-registered plan, even if tax rates increase 6% retirement at the highest margin. And we're assuming in this example that this is a 100% capital gains portfolio. If this was a 50% income portfolio, we'd have close to a 30% difference in our worst case scenario, or hopefully worst case scenario. Now let's flip this example around and look at what's hopefully a more plausible scenario at retirement. Tax rates decreasing 6% at the highest margin, down to 42%. Every column up to this last column is exactly the same. As you can see, we've got close to a $93,000 difference here. So this is a pretty big difference with a 100% capital gains portfolio. If this is a 50% income portfolio, we're looking at close to a 60% difference. So the message here is that tax deferral works. Now, I'd usually ask the audience at this stage what constitutes the top 1% of income earners in Canada, but I'll let you just think about that for a second. And think about what constitutes the top 5%. So how much money do you have to earn to enter these coveted low percentages? Well, to enter the top 1% here in Canada, we're looking at $250,000 of income. The median for the top 1% is about $450,000. Now the top 5%, we're looking at about $120,000 to enter it, and about $150,000 being the median. So just think about that. I mean, do those seem like big numbers to you? I mean, sure, it's great money, but when I think of the top 1%, I think maybe might have a couple of helicopters in the backyard, occupy Wall Street, might be able to afford tickets to a Raptors game this year if there was a season after they won the championship last year. So these aren't huge amounts on the grand scheme of things. So I ask you to consider, who do you think that the government's going to be targeting with their tax policy? Probably these people and business owners. Quick recap on what's happened over the past 4 years. 48%. So we saw tax rates increase in Alberta from 39 to 48% pretty much overnight. TFSAs were reduced from 10,000 down to 6,000. It was lower than that at one point, but it's come up a bit. On the corporate side, we've got a 50.67% tax on investments. The elimination of the multiplication of the small business deduction. So if you've got multiple different companies or multiple partners in those companies, you now have to share your small business deduction with all those entities. And income integration. The key message here, dividends don't make as much sense as they used to. They used to be a great strategy, but the gap has closed. You're pretty much paying the same tax at the end of the day if you pay yourself dividends or T4, which is why a lot of accountants now are recommending that you pay yourself T4 up to max earnings, which is just shy of $155,000 this year. And then if you need money on top, you can maybe pay dividends on top. So that's what's happened over the past kind of 4 years. Now, something big happened in 2018, and that is the taxation on passive income. So we saw some changes happen. TOSI is one of them, so tax on split income. The short story of that, well, you used to be able to pay family members with less scrutiny from the government. Now there's more scrutiny. So we got to be careful about that. And the big reason why we've seen a huge increase in IPPs, 2018, our business grew 4 times. And last year we exceeded that. So we've had a big couple of years. This taxation on passive income has been huge. So what this means is, if the government has said, we're establishing a threshold as to how much or how much money in your corporation, invested in your corporation, is too much. And they've said, okay, about $1 million is what we consider to be too much. They've assumed a 5% return on that $1 million, which is $50,000 of passive income. So any amount that your passive income exceeds $50,000 a year, your small business deduction is clawed back by $5 for every $1 that you exceed that $50,000. So this has a huge impact on corporations potentially jumping from, an 11% tax rate to close to 28%, right? So we're losing more and more advantages of being a business owner. So of everything we talked about, what are some solutions we have to help protect ourselves from these changes? One such solution is the individual pension plan, or the IPP. So what is the IPP? It's like a supercharged RRSP for business owners and professional corporation owners. It uses the 2% defined benefit, which is the richest benefit formula in Canada. And its benefits are threefold. Number one, we've got increased contribution room. So we've got a richer retirement. Number two, we've got some risk mitigation mechanisms built into the IPP. And number three, every single dollar that goes into the IPP is tax deductible to the corporation. I'm going to go through these benefits in the next few slides here. So with an RRSP, you can put 18% of your earnings into it, up to a certain maximum every year up until age 71. So that's a flat line, 18% all the way up to 71. Where the IPP differs is that percentage of your earnings that you put in increases over time, right? And that's what we see here. So age 38, is where the IPP starts to make sense, because before age 38, we can put more into an RRSP than we can an IPP. But every year after 38, the amount we can put into the IPP increases. And that's what we see right here. So at age 45, you can put 18% more into the IPP than you can an RRSP. At age 65, we can put 64% more in, or 44,600 versus 27,230. So that's just for that 1 year alone. That doesn't include every year before and after. So this compounds pretty quick. Now, with the IPP, we've got a feature that's similar to unused RRSP deduction room. So if you're entitled to put a certain amount into an RRSP, but you don't max that out, that amount over and above goes into a pot that you can make up later. Same thing happens with the IPP, but it's a little bit different. So with the IPP, when we set it up, we're asking, what would this IPP have looked like if you had it set up since you started your company, since you started reporting T4 from your company? That's what past service is. So we're essentially making up for lost time. A 45-year-old could have 300K of past service in addition to the current service from the previous slide. 71-year-old could have 1.2 million. So we've got a pretty big difference between IPP and RRSP, as you can tell. Now, these are all net new tax-deductible contributions from your corporation. There's something else that happens when we set up the IPP as well, and that's the RRSP qualifying transfer. So we're essentially going to, in addition to current service and past service, transfer a portion of your RRSP into the IPP. That's one of CRA's rules. And some folks might ask, I don't really trust this IPP yet. I don't know enough about it. And the RRSP's been around for ages, and it's run by the government. The IPP's been around since the 60s, and it's also run by the government. And as you'll see in a future slide on risk mitigation, it's like a safer version of the RRSP. So you can rest assured that this wasn't a product that we created in the actuarial laboratories at GBL. So going into risk mitigation. So first off, the assets within the IPP are held in trust off the corporate books, and they are creditor protected. So we've got that extra layer of creditor protection. We also have the ability to top up if the assets don't grow at 7.5%. So one reason why the IPP, many people might not have heard of the IPP up to this point. One reason why a lot of folks might not have heard of it is because in Alberta in particular, the IPP wasn't a favorable product. So we had a pretty low personal tax rate at the highest margin of 39%, which is pretty reasonable. We had the Alberta Advantage, so we had pretty competitive corporate tax rates. And the economy of Alberta has fallen victim to the boom bust every few years. So this 7.5% assumed rate of return used to be mandatory. So to tell somebody who lives in that low tax environment, who falls victim to the boom bust every few years, set this up, oh, by the way, you have to fund it every year no matter what, that's probably a hard no. That 7.5% top up is no longer in force for connected persons in most provinces in Canada. That's opened up the IPP tremendously, especially here in Alberta. So the 7.5% top-ups are something that you have the ability to do. So back in March, when the market tanked, we saw a number of clients top up from minus 25% return to plus 32.5% return. So that's a pretty big deduction. Now we have to be careful about that because we don't want the IPP to be overfunded by much, but it's an option. So that's a bit of our risk mitigation here. And we also have terminal funding. So before you retire, you can top up your pension. So you could take usually a few $100,000 more, tax deductible, out of your company and put it into the IPP to get indexing to inflation, a bridge pension if you retire before 65, which mimics CPP and OAS up until then, and some actuarial top-ups like survivorship and things like that. So we've got a pretty bulletproof strategy here. Now, I mentioned that every single contribution that goes into the IPP is tax deductible to the corporation, and by every single contribution, I mean just that. So there's 4 things that are tax deductible here. All the contributions, all the top-ups. So if you choose to make those 7.5% top-ups, those are tax deductible as well. Our fee at GBL, which is $1,500 for a single member plan here in Alberta. And as long as the assets are held in a fee-based account, which I'm confident they would be, the advisor management fee is tax deductible as well, which you can't do with RRSPs. So another benefit to moving the RRSPs into the IPP when we set it up is that those management fees, which weren't tax deductible in the RRSP, are now deductible once those RRSPs go into the IPP, right? To get a little technical here, the reason why that is because the RRSP is a registered account and you can't deduct fees on registered accounts. But the IPP, even though the overarching plan is registered, the account itself that sits inside that plan is a non-registered account. So we're able to deduct those fees. Let's take a look at a case study on the IPP. So what does this all look like in a realistic case? So we've got a 55-year-old who's been incorporated for 10 years. They've got employment income of what we call max earnings for this year, so just shy of 155K, and 260K of RRSPs. So what could their IPP look like? So from a contribution standpoint, we've got a pretty big difference in year 1, and I'll let the audience think about why that's so big. But before I do that, just ignore year 1 and look at where the red meets the blue every year after. And just imagine chopping that off and stacking up those reds, right? That's a pretty significant difference over that 9-year period, not even taking into account that mega year that's year 1. And as you probably guessed, year 1 is as big as it is because we've got both current service and past service in year 1. By the way, past service doesn't have to be dumped in year 1. It can be trickled in over time. You've got control over that. So that was our contribution comparison. This is our total savings comparison. So we've got the difference of about $1 million versus $1.5 million. Not too bad over a 10-year period. One thing I will add is that none of the work we do shows the other half of the benefit you get from the IPP, which is the corporate deductions. We're only showing the retirement benefit here. So you're actually getting a much bigger benefit. Not to mention the bells and whistles like creditor protection and the ability to top up and all that fun stuff. So these are our timelines. So we're looking at about, on average, it's about 3 months for an IPP to be fully approved by CRA. So myself, GBL and Canaccord and the client and the accountant, we can do our part very quickly. We can have an IPP out the door, ready to go very quickly. Usually it's within 2 weeks. If it's urgent, we can do it quicker. The holdup here is CRA. And unfortunately, CRA's processing time has increased significantly. So we're looking at about 5 to 6 months now. So we're almost into July. If you or any of your clients are looking at doing an IPP for 2020, we can't guarantee that it'll be done in 2020, unfortunately. But we'll do everything we can. One last thing I'm going to leave you with before I go over some COVID considerations is if you or any of your clients have a family business. So if mom and dad and the kids are all employed by the company and they're all earning T4 from the company, they're eligible to be added to the IPP. If mom and dad are drawing down their pension when they pass away, there is no taxable disposition on death of the last parent as long as the kids are members of the IPP. That money stays in the IPP until the kids decide they want to retire, and then they'll pay tax on their withdrawals after that. So we don't go through the estate if we have a family plan and mom and dad are drawing down when they pass away. This is extremely powerful for business owners where kids work with the company. Doesn't apply to a huge portion of the population, but the ones who it does, oh man, it's pretty big. So how do we learn more? You can download our questionnaire or just visit gblinc.ca/IPP quote. I know that the folks at Canaccord have copies of our questionnaire as well. You can reach out to them, and we'll get a quote back to you within 24 hours. Some considerations for COVID. Nothing I haven't mentioned throughout the presentation, but just to recap, because a lot of folks are rightfully worried about what's going to happen with the future, given what's happening with COVID. If you have short-term cash flow disruptions, you can pause your funding. And if you ever need access to your cash, you can always collapse the IPP, or we can make an appeal to CRA if there's any case of hardship. And you know, given what's happening with COVID, I think it's pretty likely that that appeal would allow you to get money out of the IPP for retirement. Like I said, 7.5% growth assumption, that doesn't have to be funded either. You can make those 7.5% top-ups. We can do valuations in between periods, so you can officially, you know, get those top-ups on the books. And we've got that creditor protection. So if you've got any risk of bankruptcy or creditors, you know, you're protected with the IPP, so they can't access that. So really, what we're trying to do is help business and Prof Corp owners change the narrative from thank you for your tax donation to this. Thank you for taking the risk of running a business. We know what that looks like right now. You know, it's not pretty. You're employing Canadians, you're supporting your suppliers, you're investing in Canada, you're providing value to Canadians, you're saving for your retirement, and you're paying a fair amount of tax with these plans. So that's the IPP portion. I could take a quick, I want to be respectful of everybody's time, so I could take, you know, 3 to 5 minutes to talk about the RCA, or the retirement compensation arrangement. But at first before I do that, I'll open it up to some questions if anybody has some, if they want to field those about the IPP now.
Yeah, I just had one of questions from a client. If someone is looking at selling a business in the near future, does it make sense to start an IPP in advance? And if so, what happens with the IPP after the sale?
Awesome question. So the answer is it depends. I know that's not always an awesome answer, but so it depends. So if you're selling your business tomorrow, then you know it could make sense to set up the IPP. I mean, if you're selling the business within like 2 to 3 years, then you're fine. You can set up the IPP and then either collapse it once the business is sold, or you can set it up in company A right now. And then if you sell the company, if you've got another company that you're going to start, such as a holdco, that you can get a little bit of T4 from, we can talk about that maybe offline. Or you've got another business that you're starting, we can transfer ownership of the IPP, no problem, at no charge. So if you want to keep the IPP up and running, you can do that. Just the big rule is that CRA wants to see the IPP set up for at least 3 years, just so that, like, we have to, if they see somebody set up an IPP and dump in 500K of past service and then collapse the IPP the next day, that doesn't look very good, right? So that's what we want to avoid. And every 3 years is when we go through our triennial cycle. So we redo the actual report every 3 years. That's kind of the gold standard to be able to have that kind of transaction on side with CRA. So in short, you know, you can certainly set up the IPP if you're planning to sell your business. It just depends on the situation, which I'm happy to discuss offline with you.
Just had another question. So you were saying about setting up, say someone's about to go into retirement. Say they're 16, say they're 7 years old. And they have a business partner, for instance, one that's younger. So they set up the IPP for both partners. One's almost immediately going into that 71-year-old age. How does that affect things? If that guy's continuing to, say he's planning on working until 75, 77, and he make a big lump sum, I saw the 1.1 million, would he be able to make a massive contribution like that, kind of freeze it for a couple of years and then withdraw, or what would the solution be there?
Yeah, you're forced to start withdrawing at age 71. With most institutions, you don't have to do it until the end of the calendar year of your 71st birthday. There are some that require it to happen on the birthday, but at age 71, you're going to have to start drawing down. However, the company can still sponsor the IPP. So that client could make an arrangement with their business partner to say, I'd like to have you still fund my IPP for 3 years. So there's going to be no additional funding that's going to go in. So no more of that current service funding that we talked about, but the company can still make 7.5% top-ups, right? So as long as they do that for 3 years, then we're good. But if like, let's say the client is just going to retire and not work for the company anymore, they're just going to sell it to the business partner. One thing to consider is that when I mentioned earlier that funding isn't enforced for connected persons, what I mean by that is funding isn't enforced for people who own 10% of the shares of the company or more. If you no longer own any shares of the company, then you're considered non-connected. So the other co-business owner will just need to be comfortable with a 3-year period where if we hit another March 2020 where the market dropped 25%, at the end of the year, if the investments didn't recover, they'd have to make those top-ups, right? Or at the end of every 3 years when we do that valuation. So that's something to consider. So really, if they can hold on to 10% of the shares until that point, then that would ensure they're still connected.
Thank you.
I have a verbal question. Very interesting, Ryan. I never heard of IPP before, so I was curious to get on this Zoom. Just on a lighter moment, did anybody see Jimmy Kimmel's Zoom excuses last night or the highlights?
No.
Well, you got to look it up. I'll send it to Jeff and then forward such. But yeah, I would love to, I mean, Canaccord's been good about forwarding the recorded message on this. And a lot of what you've talked about, Ryan, applies for myself. And, I would like to learn more.
I would love to discuss with you. Jeff, we can maybe coordinate that through you and go from there. And I got to say, I like the Jimmy Kimmel comment because as actuaries, we got to keep people entertained somehow, right? Showing them calculator jokes doesn't quite do it anymore. So.
Oh, sorry, my bad. It was Jimmy Fallon. Jimmy Fallon. Yes.
I'll look that up.
Perfect. Ashley, did you have any comments on this further?
No, I think it's a good explanation as well as the good to see the screen sharing. So we've been able to see that very clearly, Ryan. So thank you, because it does add to both hear you speaking about it and to see some of the major impact that the IPPs can have. Thank you.
Great. Awesome. So I can move on to the RCA and discuss that quickly if everybody likes. Yeah. Okay. I'll take a quick, like I said, I want to be respectful of everybody's time. So I'll just kind of go through and do the kind of short, impactful discussion, and we can, if there's any specific cases, we can bring those up. So here we go. Buckle up. Round 2 of actuarial bad puns and jokes. So retirement compensation arrangement, or RCA. So the RCA is less known than the IPP. It's like a supercharged IPP though. So it's a more powerful IPP, which gives more flexibility and in most cases a lot more funding room. And it's really meant for specific situations. So if we have somebody who owns a business or a professional corporation who sets up an IPP, but the IPP doesn't get them quite as far as they want to go for money they want to pull out of the company and tax deduct. If we've got those limits of the IPP that aren't high enough, then we can oftentimes build an RCA as a top hat plan to be able to shelter the rest of that money that they want to move. So that's the first case where we see a lot of RCAs, is if we need more room. The second case is if we need more flexibility. So I mentioned with the IPP that funding is no longer enforced for connected persons. For non-connected persons, it is enforced. So all those contributions have to be made, as do the top-ups. So what happens if, Canaccord wants to set up RCAs for its employees, or let's say IPPs for its employees? Well, if they wanted to set up IPPs for their employees, they'd be on the hook to fund the IPP every year and top it up. Now, I assume that nobody at Canaccord owns 10% of the shares or more, or you probably wouldn't be sitting here on a Wednesday morning going through an actuarial presentation. You'd probably be somewhere sunny, enjoying the weather. So that's where the RCA comes in. So the RCA doesn't have forced funding for non-connected persons. So the company could say, I want to either give you a tool to put your variable pay or your bonus into, where you have more control over the tax you pay, or I want to build this in as part of your retirement planning, right? So we can build an RCA into a supplemental executive retirement plan, or a SERP. So a SERP is like an earmark of executive compensation, or golden handcuffs, let's say. And the RCA is the tool which is used to get that money out of the SERP in most cases. So number two, so we talked about number one being we need more room. Number two, we need more flexibility. Number three, special situations. So if we have a case of executive compensation, we just talked about that. That's one. We do a lot for NHL players and professional athletes in general. Anybody who's going to cross the border, or any border, be it provincial or federal borders, if you go to a place that has a lower tax jurisdiction, then you can collapse the RCA at those lower rates. So if you fund the RCA in, let's say, Alberta or BC, which would have a 48% to over 50% highest marginal tax rate, and you go down to, let's say, Texas, you collapse the RCA there, you pay a 15 to 25% withholding tax to the Canadian government. That acts as a credit against US federal tax, and there's no state tax in Texas. So as you can probably see, it's pretty good in that case. And finally, unfortunately, we are seeing a lot of executive severances happening, particularly here in Calgary. Between COVID-19 and low oil prices, it's been a very bad time for Calgarians. A lot of good people are being terminated because of circumstance, not cause. So the RCA is a good way for that company to say, you've been a great employee, we have to let you go. Here's a way that you can keep more of the severance money we're going to give you. So I'm going to go over one of those examples in the next couple slides. So just to go over the important considerations, again, we're seeing a lot of executive severance. If there are companies who are doing well through COVID, we're seeing RCAs get up for, we're seeing RCAs get set up for cases of golden handcuffs or executive compensation. The important thing to keep in mind is if a company sets up an RCA for an employee, oftentimes they view it as a risk because it's something that they probably haven't done before. So inherently that's considered a risk, but the company gets the same tax deduction as they would if they didn't set up the RCA. And once that promise has been made full, all liability ceases. And the RCA is a CRA created plan. This has been around since the 80s. So again, it's not something that we created in GBL's basement, right? So 2 more slides to go. This slide is going to discuss the structure of the RCA. So as you can see here, we've got the entities, so the sponsoring company, and the retired executive. So we're just saying a retired executive in this case, as an example. So the company, in order to put money into the RCA is not one account, it's 2 accounts. So we've got the investment account, which Canaccord manages, and the refundable tax account, which CRA holds onto as a security deposit. So when you were in university or college, you had your apartment that you had to put your security deposit down on, and you got that deposit back if you didn't wreck the place. Same idea here. If you don't wreck the place with the RCA, you get your deposit back. So the downside of the RCA is that that deposit is half of what goes into the RCA, or half the growth. So if we have $100 go into the RCA That $100 would go into the investment account, and then $50 would get moved into the refundable tax account so that both of these accounts balance. That's the key here, is that they're always going to balance. On the flip side, if $100 comes out of the account, 50 goes back, right? So the balancing goes both ways. But the downside is that the RCA refundable tax account is pretty much sitting in cash, not growing interest. So a lot of folks watching are probably wondering, why in the world would I set up an account where only half my money grows and the other half goes to the government, right? Pretty valid question. The answer to that question is that this refundable tax account is an opportunity cost for this. So this is an executive severance example that I mentioned I would discuss with you. So this is the easiest way to describe the power of the RCA. So we have two executives here in Alberta who are severed. They're each paid $375K in a lump sum severance. Executive A decides, you know what, I don't like this idea of half my money going to the government. They take that money as income. It's considered income, so it's subject to full taxation. We're assuming they're already in the highest income bracket, so they're subject to 48% tax on that money. They're going to pay $180K of tax. They're left with $195. Ouch. Now, Executive B decides to give the RCA a shot. They put that entire $375, so the company deposits its pre-tax into the RCA. They decide that they're going to draw down that $375K at $125K over a 3-year period, or over a 3-year period. Their average tax rate is reduced to 26.9%, and they're left with 41% more in the RCA than if they would have just taken that money as income. So even taking into account the fact that half the money grows income because the other half is held onto by CRA, you're still 41% better off. And that's just one of the options this executive has, right? They can draw down over time. They've got control. They can draw down over 20 years, 40 years if they wanted. Let's say they have enough income throughout retirement to sustain them. They don't need the money in the RCA. They can leave this money in the RCA. When they pass away, it rolls over to their spouse. Spouse passes away, the RCA can go to the kids. Right? Then the kids can draw down. It doesn't go through the estate, it goes straight to the kids. They can draw down over 20 plus years. Right? So if there's $1 million, if there's $1 million in that RCA account, they can draw down $50,000 a year over 20 years if they wanted. Right? That's pretty powerful. Now, this executive can also say, well, I might become a non-resident of Canada for a couple of years, right? So they can go down to the US and collapse at a lower tax rate. We had an executive here in Calgary do that some time ago. So they had a very large severance. They put it into an RCA, went down to Nevada, which has a 0% state tax. They collapsed the RCA. They shaved $6 million off their tax bill, right? So this is a very powerful tool. And the reason why CRA holds on to half the money is because they want to make sure that you don't go to Switzerland and pay no tax at all. So that's the RCA in a nutshell. How do we learn more about the RCA? Same method as the IPP. So, and with that, I'll open it up to questions.
Just a quick question. DPSP. Is there any, what's your opinion on those?
You know, we don't handle profit sharing plans. So they can certainly, it's a good tool, but you know, I can't really comment because it's not something that we handle. The RCA is really meant to be able to get money into a vehicle which allows the individual to draw down as they see fit and get some other benefits such as the cross-border considerations or passing money down to the kids and all that. So
Okay. Anyone else with any questions? Feel free to throw them in the group chat. It's a little smaller group today, but if you feel comfortable, just unmute your mic and ask Ryan. Happy to help on this. This will be recorded, and so we'll send you the follow-up links afterwards as well. So
Yeah, like I said, Jeff, I'd love to follow up on this Zoom call. I've actually been talking to my accountant about buying a place in the Isle of Man to avoid paying Justin Trudeau any money. Ryan's smucking, he knows what I'm talking about.
I'm a big Scotch fan, so.
Yeah, and hey, you get to see a motorbike race every year.
Yeah.
Perfect. Yeah. Well, I'll give you a chat afterwards, and happy to talk further. We'll work with Ryan, or GBL at least. I've had accounts with them for the past 7 years, so yeah, it's a great advantage. It's one that's not discussed all that much. It's a little bit more complicated and not as mainstream, but neither is a lot of people who succeed with their businesses and want options. So we're more than happy to help you and help your business and help your retirement. That's what we're here for. So.
I would like to thank you, Ryan. Thanks very much for helping to educate all of us today, because it's important that we understand about IPPs and RCAs and know that they're available, and especially in light of changes such as COVID and things, market changes, it's really important for us to be reminded of the value in these. So thank you.
Thanks for having me. Like I said, it's always a pleasure to present with you both, and glad that you're both keeping healthy and well. So.
Thanks again, Ryan. And I guess with that, we'll wrap it up. If you have any questions, feel free to email me. I'm more than happy to connect you with Ryan. Ashley is a perfect time to review your financial plan. The world has changed. It's not just a typical thing. It is important to just update those continually to make sure that we're on the same path, regardless of what happens, whether it's COVID or something else. Again, we all want you to get to the same goal, and that's that financial freedom into retirement and enjoying Mai Tais on a beach somewhere one day. But perfect. Well, thanks again, everyone, and I'll leave it there. And like I said, feel free to reach out to us. We'll be posting this on our Facebook and YouTube, and as well as posting it on the website as well, so that you can review it. And that's mywealthmanager.ca. Perfect. Have a great afternoon, everyone, and we'll talk soon. Thanks again.
Fantastic. Thanks, everybody.
Thank you.